Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending June 24th, 2022. Sorry I missed last week. I was on vacation and it was a nice little R&R. But as usual, when I go on vacation, the market brings some volatility. Luckily, we came back and the market this week was in a holiday shortened week was very, very bullish. And I'm going to title today's video Major Support and Dovish Data Sparks Rally. And that's really what happened here over the last this week. It was pretty much a light week when it came to economic data overall, but I'll go over it real quick. Monday, the market was closed, but Tuesday, we had existing home sales. That came in down a little bit, 3.3%. So that's certainly very important to the broader economy and other parts of the housing market. And then today, on Friday, we had new single-family home sales. That actually surprised the upside of 10.6% month over month. And obviously the new home sales, that's a very small portion of the housing stock. So it really benefits, the trends there benefit the home builders mainly itself. Whereas existing home sales, that helps all types of, the commissions for real estate agents. You have title companies and things like that get a big boost from those sales. So the broader housing market certainly is decelerating, but new single family home sales had a nice little rebound in the month of May. So that was a big spark in that sector overall. Now the Kansas City Fed Manufacturing Index, that came in at -1 here. So really a nice little shrinkage. You saw this came in negative back during the COVID crisis as expected. But even 2016, you saw this turn negative a little bit, but we were in a recession. So just because it's negative doesn't mean that you're in a recession, but certainly you're seeing manufacturing activity, at least in the Kansas City region, decelerate pretty decently. Then you had initial unemployment claims. I think that was on Thursday or Wednesday, and you can see that it was actually flat week over week, but the 4-week average continues to trend higher. So the labor market is certainly weakening to some degree, and that's feeding into the consumer sentiment index. And this chart, this is what's interesting here. This chart goes back to 1952, 70 years. Yep, 70 years. This is the lowest reading in the history of the series. The lowest reading. So it just shows you that consumers are not very excited about what's happening in the economy. High gas prices, high mortgage rates, that's certainly hurting, what they probably feel is the value of their home. And then if you don't own a home, the ability to just go out and buy a home, and kind of stuck with that. And you probably see just in the labor market weakening to some degree. I can't even imagine what happens if unemployment rate was north of 5%, what that consumer sentiment index would look like. So all this together really shows that the Fed is likely to pivot, and we'll dig into the charts here and talk about that in a little more detail. But what I'll start with is the NYSE. I'm going to go to a weekly chart here. Now, this is textbook technical analysis. When you're looking at charts, you want to line up multiple factors, okay? So here's the fib retrace, right, from the COVID bottom to the recent peak, and you're getting a retrace. Not uncommon, very, very often this happens. This is kind of how the market works, right? You go up, you pull back, you continue to work higher in a zigzag pattern, and it's been doing that for over 100 years. Some of the pullbacks are very large, some of the pullbacks are more modest, and you might feel like this is a large one. It's not really, to be honest with you. It's a normal garden variety pullback in the market, and they usually hit support levels. And you always want to line up various factors. Ideally 2. This one actually had 3. And you can see here is the 0.382 retrace, which is the 0.25 is has some power, but the two strongest are always 0.382 and 0.618. Those are the two strongest of the Fibonacci retracements. And you hit the first one on the NYSE. Remember, the NYSE is the broader index, 2,500 or so different stocks, as opposed to, most of the indices. At most, you're looking at Russell 2000, but that's usually all small caps. But NYSE is broad, up and down, from large cap, mid cap, small cap, growth versus value, etc. So it's a good representation of the equity markets as a whole, a better one than just the S&P, which most people follow, and way better than the Dow that a lot of people quote. So I always like to look at this one. And you found that support there, the 0.382, but you also had a couple other things to line up as well. This 200-week moving average, this purple line, hit that nicely. There's two factors. And there's actually a third, and that is this breakout area. So when something breaks down, rallies, and then breaks out above the previous high, when it returns to that level, that previous breakout area, that is support. So to get a bounce here in the market from a technical perspective is not shocking at all. And frankly, I was kind of feeling it last week, especially with the sentiment indexes. I think it was like the CNN Money. It was at the sentiment reading, fear and greed reading was at zero. So, and I just seeing articles and CNBC, and you've done this long enough, you go, okay, people are just really getting too bearish. Yes, the Fed's being hawkish, but at the end of the day, there's the economy's still growing. It's not falling off a cliff. This isn't the financial crisis. So to see a rebound for sentiment from technical perspective, not shocking at all. So there's that. Now the big question is, where does it go to? We'll get to that at a later date. But I do feel like we are going to bounce here for a number of weeks, maybe a number of months. Now, is it probably a bear market rally? Probably. Because while the Fed is likely to moderate its pace of tightening, it's unlikely to reverse, right? They're probably not going to go back to QE anytime soon, not going back to lowering rates anytime soon. It's just, hey, are they going to raise 50, 75 basis points per quarter going forward? Probably not, based on the economic data that is coming in and the fact that they've technically kind of broken the commodity markets. And I'll jump there real quick before I get into other broad indices. So here's the DBC, and here's the weekly. And you can see this is the broad commodity index, and that has now broken lower. So, not in a dramatic fashion, but having a garden variety pullback. You have the XLE, the energy space. That's having a pretty swift, strong pullback, which is we expected a pullback this summer to happen, and you're starting to see it. And what I expect is kind of an ABC pattern before the next uptrend. So you're getting this A pattern, this A leg. You'll probably get a B leg, lower high, probably somewhere into this level. See where this previous broke down and broke out, and then maybe a lower low before your ultimate buying opportunity. But I do think that this is going to be buying opportunity longer term for the energy space as a whole. But it just goes to show you that the fact that you look at USO, just oil fell from about 120 now down to the low 100, right around $100 a barrel. So certainly that's going to have an impact month over month, year over year on inflation, and just the economic data rolling in certainly is showing that the Fed's tightening policy is having an impact on the broader economy and inflation. Okay, so that's why I titled this video, there's major support and dovish data sparking this rally. Once again, think it's probably a bear market rally, probably ultimately head lower later in the year, early next year, etc. But that's what I'm seeing kind of near term. Now let's pivot over to the Russell 2000, and I'll also go over to the weekly chart. And the Russell is always going to be more volatile, so those pullbacks tend to be more violent. And you kind of got that one here. What's interesting here is you did close last week below this 50% retrace and still got a bounce, kind of at a little bit lower level than this breakout area. So ultimately, do we get back down to 1,500 or so on the Russell? Probably, but you certainly could get a bounce, and it could be a significant bounce. Okay, if you look at, let me cut this. If you look at, let's go to a daily. what you probably want to look for is, okay, where is this going to retrace to and find some levels. Okay, so here's this. So yeah, here's the 618 would be this little pivot right here. So you could have a significant rally in the Russell based on a pivot from the Fed to a less hawkish policy. How far does it go? Maybe only gets to, the 382. That's certainly possible as well. So there's certainly a lot of possibilities on this rally. It could be just a minor rally to the 50-day moving average. Here's the NASDAQ. Maybe we hit the 50, and that's the end of this little rally here. That's certainly a possibility. But I am seeing some underlying strength in the economy, or in the markets, at least near term. So here's another one with the NASDAQ, obviously weaker, just like the Russell. Concentration of where most of the sell-off has been, and is hit the 100-week moving average. This little area here as well as support. So see this reversal candle. So it found some support there, but I do think ultimately you get down to this previous breakout area, 9,700 or so. I do think before this cycle is over, before this bear market is over, you get below 10,000 on the NASDAQ overall. So once again, probably a bear market rally, and a bear market rally in growth versus value as well. So this is also telling us that the Fed is likely to pivot a bit more dovishly, or let's just say less hawkish. And you're going to get likely a rally led by those oversold names in the growth side of the market. There's a lot of probably shorts as well that have built up within that space. And often in bear markets, you get very swift, strong, short covering rallies. And it looks like that looks to be in the cards in the near term. So if you're overweight growth, you're just investing in the indices. If you're trying to pivot to the things that are likely to do well over the next decade or so, in an inflationary environment, you're going to want to use this opportunity to sell into the strength of the growth stocks of the indices and move into commodities, industrials, basic materials, real estate, financial services, the areas that do well in an inflationary world. So just a quick heads up there. Now let's pivot over to the VIX real quick, and another indicator that we're likely to see at least a near-term bounce is lower highs on the VIX. Now you still have higher lows, but that could certainly change. Do we break this level on the VIX next week or the week after? I think that's highly possible. Now here's the VIXN. This is the NASDAQ volatility index, and you see that made an even more pronounced lower high here. So certainly watching that. GVX, the gold index, gold volatility. What was interesting is gold had a pretty big sell-off yesterday. Okay day to day, but still not breaking out. If this broke out, that would make me a little bit more worried about the gold price. You can see that when that kind of broke out to the upside above the 20, that 20-day moving average, gold was having a large pullback. That was this move here. But so far on this up kind of sideways pattern, you're getting a little bit of divergence here on the MACD. The gold volatility index is not breaking to the upside, which to me tells me that gold so far is holding in well. It still needs to hold this uptrend line, but it's fine for now. So I'm not too worried about the gold market. Same with the GDXJ. You're starting to see a higher low here. MACD divergence. See how this is close to a new low, and the MACD isn't even close to that. So I'm turning a little bit bullish on the gold market, kind of in the medium term. So there's that, and then TNX. Let's look at the 10-year. You saw a pullback in rates here. This is about a 50 basis point drop in just the span of a week, and a lot of that had to do with the economic data and the breaking of the oil prices that are likely to lead to a moderation in inflation. Now, we were expecting inflation to moderate in the first quarter of this year and peak, but you had the Russian invasion, you had the sanctions, and that certainly drove a continuation of that inflation over the future few months. But now that the Fed has responded to that in an aggressive fashion, I do think that inflation is going to moderate. The dollar, that one also looks to be, look at this divergence here, a higher high, but look at the MACD, a lower high. Is that telling you something? The yen is sticking to its yield curve control, and look at here. more divergence, lower low on the yen and a higher low on the MACD for the yen. So also telling me that we could be in a near-term low for the yen and a weaker dollar. And a weaker dollar, that's typically good for the equity markets overall. And then you look at short-term rates, not just the fact that, remember this SHY, so this goes up, means yields are going down. And this is also a divergence. Lower low, what's the MACD doing? Higher low. So things that you want to really pay attention to and realize that it's kind of telling you something. And you can see that with the leadership in the market as well over the past week or so. Look at ARK, a higher low here. The market made a lower low. You look at the S&P, the market kind of broke down, and this actually broke down and made a slightly higher low, which probably is a signal that we're going to get some sort of near-term short covering rally in that space. And then look at the utilities. This also broke down as rates really broke out, and that's reversed in a pretty solid fashion over the past 4 days, really since this entire week. And remember, utilities are bond proxies. So if utilities are doing well, then that means that the expectation is that rates are going to fall. And so the fact that this is reversing rather quickly is a signal, once again, that money is flowing into utilities in anticipation that there will be money also flowing into bonds as well. And I think that's about it. Covered a lot. I know I missed a week. Sorry, I was on vacation. But hopefully this illuminated a lot for you and gave you a sense of what we're thinking in the markets and kind of what I'm seeing. So I appreciate you all tuning in. A reminder, the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in an investment or to participate in a strategy. The views are my own. Do not represent those of KPP Financial and those associated. Thank you all for tuning in, and you have a wonderful weekend.